Well, good morning. Thank you very much for joining me on this video. As you can see, our format's just a little bit differently. Normally we just have a discussion one way, but today I've got a guest in the studio. I'm very happy to introduce to you Mr. John Tyber, who's the managing partner with Crawford Smith & Swallow, one of the very progressive accounting firms with offices throughout Niagara. John, welcome to the show. Thank you for coming by.
Thanks for inviting me.
Yeah, great. I want to talk to you today a little bit about estate planning, if you like. Understand that in this country we've got 27% of the population that is baby boomers, and it's estimated in the next 5 years, by 2026, over $1 trillion will be transferred to the next generation. Understand that most assets are real estate, and in many cases it's a principal residence which isn't taxable, but that may have implications depending on when the property is actually sold. Is that right?
That's right. When the person passes away, they're deemed to have disposed of everything on the date of death. And on principal residence, there's a principal residence exemption, so any capital gain up to the date of death is tax-free. Still has to be reported on the tax return, but it's tax-free. Depending on how long it is in the estate and how active the real estate market is, there could be exposure to a capital gain within the estate.
So let's take, for example, in our current situation, in the month of January, real estate in Niagara went up 6.9%. Yep. So from the time of someone's passing till the time the principal residence, for example, is sold, it could have gone up 10, 12, 15%. How do you establish the value at the time of the deemed disposition? And of course, if you're going to choose to sell it, then at the time of the sale, you know what that price is. How do you establish the price to begin with?
I suggest to my clients that they get an opinion of value when their parent passes.
Okay.
And that establishes the value on the date of death.
And so if the home is being left to, for example, a child, and they're going to inherit it and live in it and not sell it, then it would be a case of another opinion of value at the time the title changes hands?
No, there's no capital gain in that case. The child gets the property at the cost base on passing.
I see.
It's when the property is sold to a third party that triggers a capital gain.
Okay, so I teach a seminar, Money Machine, where I encourage people to invest in real estate. And indeed, there's going to be a lot of investment real estate changing hands as well. That is subject to tax. So what happens, I'll give you an example. Let's suppose you purchase a rental property for $200,000, keep it for a number of years, and at the time that the owner passes away and there's a deemed disposition, it's worth $700,000. So there's a capital gain of $500,000. Mm-hmm. So what would that be? It would be half would be shown as income on the estate's income tax?
Okay, everything's disposed of on the date of death.
Right.
So on the person's final return,
filing,
before it goes into the estate, that's when they would show the disposal of that property.
Okay.
And they would pay tax on whatever marginal tax bracket they're in on the $250,000.
So if the increase is $500,000, capital gain at 50%, they'd show $250,000 on the estate income tax as earnings.
No, not again. Just I'm playing with fine-tuning things. It's not in the estate.
You're accountant, you're allowed to do that.
It's not in the estate return. It's on their final personal T1 return.
Okay.
That they show that capital gain. But yes, the estate is responsible for paying the tax, but it's reported on the person's. So if they have other income from old age security, from other investments, it just gets added to the top of that on their final return.
Right, and then if that property's been depreciated over time, there's recapture to pay as well.
In that return as well, yeah.
So it could be $250,000 as capital gain payment and $50,000 recapture. It could be $300,000. I encourage people to buy 10 properties over a period of time, so all of a sudden their tax exposure is based on $3 million. How's the state going to do that? How are they going to?
Well, it depends on what kind of tax planning. Some people may have purchased life insurance, and the life insurance proceeds can help offset those taxes. But sometimes the estate has to make a decision, or the beneficiaries have to make a decision on how to finance the taxes. Do they dispose of properties to pay the taxes, or do the people inheriting it refinance the taxes?
That's really the choices they have, is to either sell it or refinance it.
Yeah.
Okay, and what's the time frame? Suppose a person passes away in October. What's the time frame as far as when the tax has to be, when it has to be reported, when the tax has to be paid, that sort of thing?
On the year of death return, you have up to 6 months from the day of passing, or April 30th, whichever is later. So you picked October 30th, 6 months happens to be April 30th.
Okay.
So that's the same. But if someone died in December, they have until sometime in June to file their final T1 return. If they died in January, they have until April 30th of the following year to file.
So they'd have a year and change?
Yeah.
Okay. But it looks like regardless of what, anybody who is a baby boomer who is sitting on a lot of real estate and a lot of equity needs to do some planning. There's going to be some tax implications.
There's going to be some tax implications.
And I guess if $1 trillion is being changed hands in the next 5 years, the government's just wringing their hands figuring out how they're going to...
They're waiting for it.
How they're going to get their share of it.
And I encourage people to talk with their tax advisor to see what their individual circumstances are, because I'm not going to say there are ways to get around it, but it's worth the discussion.
Okay, so there you go. When we're looking at estate planning, we need to give some thought, even to the principal residence, if there's a delay from the time a person is passing on a deemed disposition till the time the property is actually sold, if there's an increase in price. And certainly if it's investment property, there's going to be some tax implications and we need to make plans for that. John, thank you so very much. And thank you for joining me on this video, and we'll look forward to talking to you again very soon.